Hello, everyone. This is Jason Coddington with Coddington Wealth Advisors, and happy summer. And this installment of Student of the Market, July 2020, we'll be looking at some key indicators of the market going forward as we head into the third and fourth quarters of the year. So, hope you enjoy. Okay, so let's dive into the Student of the Market for July and see what we can learn. And I think you'll find out there's some interesting concepts to be addressed this month. So we'll just dive right in. So our first slide to review is on record. June of 2020 was the 9th best calendar quarter for the United States stocks. If you look at, the quarter return was 20.5%. So again, if you were out of the market, you missed that. And if you stayed invested, you are rewarded for your discipline. The next thing that's important is if we go all the way back from 1926 to June 30 of this year, you'll see that the average one-year return following the top 20 calendar quarter is 14.7%. Again, no guarantee of future results, but history is, success is on your side should you stay invested. So with that said, that will kind of lead us to some, so remember this slide because we're going to talk about something in the next couple slides that are going to be show you something that some people missed out. So, and that's this one here, is that if you notice, we have the record assets in money market funds. So if you go back, remember, the second quarter for 2020 was the 9th best calendar quarter for U.S. stocks on record. Yet, that being said, a lot of people missed it because we have more assets in money market funds than we ever have had. You can see we have 4.8 trillion, and that's more than 1 trillion if we go back to January of 2009. So, that's just a lot of money on the sidelines when a time when the market, went down, of course, but then also rebounded. And I think the next piece is this, as we look at this graph on the right, is the 3-year U.S. stock performance following peak in money market funds. You can see, historically speaking, 16% and 19.2%, respectively. So again, no guarantees for future performance, but history has shown us that markets tend to perform well when there's high levels of cash and after there's been a good calendar quarter. The next thing to consider is there's a lot of sectors right now that are undervalued. And so there are some that are also overvalued. And so what does that mean? That means that if we were to look up the S&P 500, there are certain sectors such as energy, financials, healthcare, industrials that all make up the S&P 500, and certain sectors perform better than others at different times. But it's interesting to note is when you review performance following a sector weight historic low, which is the yellow bar here on the right, there are a few sectors to be noted for. So again, portfolio managers we work with and use will show you that you can see consumer staples is underweight. Its average is 9.9. It's currently 7. Financials are currently average sector weight is 8.2. It's currently only 2.8. 15.9 in financials and currently 10.1. And then of course, if we look further down to industrials, that's 11% historic weight, and it's currently 8. So again, there are certain parts of the sector of the economy that will likely, bounce back because they're underweight. So something to be considering. And again, as we review your portfolios, we'll take advantage of these underweights as well. Growth versus value. So for the first time in quite some time, and it's very rare for energy and financial sectors to trail the S&P at the same time. So again, that whole being overweight or underweight makes some sense to start looking at financial stocks and energy stocks relative to the S&P 500. So as we look with our portfolio managers and as our individual sectors in your portfolio, it's likely that we will have some overweight exposure into energy and financial stocks just because historically speaking, they are underweight. And then this one is very important because this is going to show how it works with individual stocks versus U.S. stock funds. And so this goes back the last 5 years. And if we were to look, there's been 1,793 positive stocks in the last 5 years and 1,828 negative performing stocks. So that means about 50.5% lost money. So essentially a coin flip. Speaking in odds, whether one stock goes up or down. If you were just to stay invested for 5 years in United States stock mutual funds, 1,638 were positive and 134 were negative. So only 7.6 lost money. And if you just focused in United States stock ETFs, so exchange traded funds, there's not as many, only 236, but only 10 of them were negative. Only 4% of those lost money. So over time, it's very difficult to be consistently good being an individual stock picker as an individual investor. That's why you'll hear us suggest diversification using mutual funds and exchange traded funds. This graph, this slide represents it quite eloquently. Next, one underutilized part of the portfolio management is, and when we look, is a sector or an asset class called emerging markets. And if you see here on this graph on the left, the emerging market stock fund flows are actually down. So there's been 17 billion taken from emerging markets and placed somewhere else, largely probably cash, like we learned earlier in this presentation. So, but what's key here is how emerging markets perform following a major outflows. And if we look, it's averaged 15.6 following outflows. So again, emerging markets, that would be Brazil, China, India, Russia, those economies, those are just four of many emerging markets. And one of the considerations is that if they're underweight, might be a place to consider in your portfolio because they are undervalued currently with respect to all other equity positions in the world. So interest rates, this is very important. Probably something very unique if we were to look at the last 8 years, going back to July of 2012 to June of 2020. You'll see that interest rates went from 1.4% in the 10-year Treasury all the way to 3%, down to 1.4% again, up to 3%, and now as of March, down to 0.5%. So think about that for a minute. That's locking up your money for earning 0.5%, being in the market for being held up for 10 years. So you're willing to earn 0.5% on your money for 10 years using U.S. Treasury bonds. What that means, if we look to the chart on the right, is that the longer you hold, the longer your bonds are, okay, the more sensitive they're going to be to interest rates. So if we look bond fund and interest and index performance when interest rates go up, if we look from July 25th of 2012 all the way to June 30th, you can see on the far right-hand side, long government was down 9.9%. So you might be getting income, but you need to be prepared that your portfolio is going to go down in bonds by 9.9%. And then, of course, if you move left towards high yield is riskier, but as interest rates rise, typically perform better. So as you're considering your bond portfolio, some things to consider might be if you're underweight high yield bond or overweight long government, that might be something to adjust. And that concludes our presentation for the July Student of the Market. Again, if you have any questions at all, don't hesitate to call us or email us, and we'll reach out and help. Thanks so much.